All right, I think we're ready to get started here. Let me see here. So, Greg, I've got you teed up to take over the screen here in a moment, but I wanted to first just introduce everybody, let you know what's going on here today. Um, this is the Elevate July event. It's going to be our last event of the summer. We're taking a break in August. Lots of people traveling. But like I said, I'm Adam Koch, business transition consultant and founder of Elevate. And I'm also the president, portfolio manager, and senior financial advisor at Libertas Wealth Management Group here in Columbus, Ohio. And I'm hosting alongside financial advisor, certified retirement plan counselor, and certified financial planner Kim Warwick. A little housekeeping as always. Elevate started with three statistics in mind. The first is 80% of business owners' net worth is tied up in their business. This probably sounds familiar to most of you who are watching or listening. The second one is 80% of businesses never sell. They dissolve in the end, leaving the owner or owners with nothing to show for their life's work, which is mind-blowing and disappointing all at the same time. And then lastly, of the 20% of, or so of companies that do sell, 75% of those 20% exit their businesses for less than fair market value. So with that all being said, Elevate started with these three statistics in mind, and it's crucial to understand our mission and that all the education we share, as well as the consultation we offer through our professional partners, Joseph Sophia and Greg Darty, who are presenting today, being two of those partners. Um, I always say that we need to get the phrase exit planning out of our vocabulary because it doesn't matter if you're planning on selling your company in 3 years or 13 years. Business transition planning is something that every growing and or mature business needs to get unstuck, take their company from good to great, as Jim Collins says, and whether you're selling soon or not, to treat your business and plan to create a sellable enterprise today. So for more information on business transition consulting, exit planning, retirement planning, executive benefit plans, and investment management for business owners, head over to elevateandexit.com. Be sure not to miss any of our future events by subscribing to our YouTube page where all of these webinar replays are held, as well as the podcasts that we publish. You can find there as well as on Apple Podcasts. And you can head over to our website at elevateandexit.com to sign up for our exclusive educational podcast articles and live events that we ever hold, all of which are aimed directly at growing your business, increasing profits, increasing efficiencies within your business, reducing the amount of time required for the owner within the business, de-risking all while growing your enterprise value, your company, along with your net worth so that you can make work optional and lead a stress-free lifestyle, which is, I think, what we all want at the end of the day. So one last piece of housekeeping is that all guests and attendees will remain intentionally confidential throughout this entire presentation. We do that on purpose, and that includes the Q&A session that follows at the end. So as you're listening and or watching, please feel free to add either to the Q&A or the chat, whichever's most comfortable for you. Kim and I will be monitoring both. So any questions you have, add it to the chat or the Q&A. We'll compile them at the end anonymously. We won't be using anybody's names, after which all questions will be answered at the conclusion of the presentation. And if for any reason, by the way, if we happen to run out of time and we can't answer all the questions, what we'll do is we'll send out an email to all of those who attended along with the questions and answers privately after the presentation is over with. So let me get into introductions here and we'll get started. So I'm thrilled to introduce our two speakers today. We have Joseph Sophia and Greg Darty. Greg is a partner at Porter Wright Morris and Arthur and focuses his practice. He's one of the few, I think, in town that focuses almost exclusively on executive compensation, employee benefits matters, has a very, very strong experience with ERISA and publicly traded and privately held companies, as well as nonprofits. He has extensive experience assisting business owners with their succession planning needs through the implementation of ESOPs, which is what we're going to be talking about today. It's pretty hot topic. I think a lot of people know generally, or at least on the surface, what an ESOP is, but there's so much more below the surface, which is why we're doing this presentation. That's why we're recording a podcast as well. We'll be doing an article on top of that. So Greg is kind of our attorney here that has a ton of experience specifically with ESOPs. So I'm excited to hear what he's going to have to say today. And then we have Joseph Sophia, who's the regional president for First Financial Bank here in Central Ohio, which includes the oversight of both commercial banking and middle market banking locally. He's got extensive experience in finance and stabilized commercial real estate, but his expertise spans not just loan origination, but also portfolio management, credit analysis, all while helping companies with funding for change of ownership, including but not limited to management buyouts, ESOPs, again, what we're talking about today, passive investor relations, SBA, private equity, strategic buyouts, and so on. So he's kind of our go-to guy when it comes to anything having to do with business banking, lending, and so on at Elevate. So again, prepare any questions. We'll have anonymous Q&A at the end of this presentation, but let's go ahead and dive in and learn from two of the best in the business. So enjoy today's webinar, and let's all gain some valuable knowledge on employee stock ownership plans. So Greg, Joseph, I'm going to go ahead and turn it over to you.
All right, thanks, Adam. And I will share my screen, see if this works. All right, good. Yeah, so kind of to Adam's point, the reason we're talking about ESOPs is that every business is going to have some sort of succession, and it will have some sort of succession, whether you want it or not. You could, if you do nothing and die with your boots on, you may leave, depending on how your family feels, it could be a good thing or a bad thing. But it's always better to plan ahead, and there's different ways of going about succession planning, whether it's to family, whether it's to strategic or financial buyers, or whether it's some form of employee ownership. And the reason Adam wanted to get this group together to talk about employee ownership is because if it's the right fit and it's done properly, ESOPs are very tax advantaged, and they can actually help accelerate growth of the company. Provides a unique set of advantages to the sellers, to the business owners, to the company, and to the employees. I don't know, Joe, as a banker, what you see maybe comparing ESOPs to non-ESOP companies.
Greg, can you hear me okay?
Yes.
Great. I think what I would do, so full disclosure, Adam, as you mentioned, we've done several of these together. Then Greg does a lot of these. We tend to team up on some of these. So to answer the question, what I thought I would do is ESOPs can mean a lot of different things to a lot of different people, and it's normally something you only do once. So what I would tell you is ESOPs historically, so 10 or 15, 25 years ago, I think people would do an ESOP when they couldn't find an alternative. So maybe they tried to sell to a friend, a neighbor, a key employee, maybe private equity, and they did an ESOP, and it was like the last resort. What I would say is over that same period of time, ESOPs have become significantly more sophisticated, and in terms of who's doing them, and then that involves a bank. So, imagine, 50 years ago where you'd walk onto a car lot and you had to pay cash for the car. Cars were a lot cheaper and the process was less complex. It's a lot more complex now because banks like mine will lend money for the ESOP, and we can get into the detail. But that's what I want to share with people, though, is you're probably on this webinar because you've heard a little bit about it. Maybe a client of yours is an ESOP or you're considering one. It's something that I think you've got to do a little more due diligence on the front end, but at the end, it can often be easier, and you kind of know your path forward. Where if there's anybody on the webinar that's ever sold a company, or if you've ever sold anything like a house, initially you think it's going quickly, and then at last minute, it kind of it can fall apart. That's unusual for an ESOP. It's normally slower on the front, and then it kind of moves quicker on the back end. And the ESOP companies at the bank, they tend to perform pretty well. We actually have a lower loss. And so at a bank, you make a loan, and sometimes people don't pay you as agreed, or they're late. And then at some point, maybe the loan goes bad, meaning, now we have to sell assets. And at the end of the day, we end up, let's say we lent somebody $1 million and we only get 800,000. So we lose 200,000. ESOPs tend to perform significantly better. And I think one of the main reasons is the employees are their owners, they're vested. So I think that was probably what you were driving at, Greg, is that even though we can get into as much detail as the group wants, the loan structures can be complex and at first blush more risky than other loans banks make. The actual performance of the loan and loans to ESOPs to do better. Does that answer your question? Is that what you were looking for, Greg?
Absolutely. Yep. And it's a great segue because I've got a couple slides just showing different statistics about ESOPs. Last one, loans, according to the National Center for Employee Ownership, loans to ESOP owned companies default at about 10% of the rate of non-ESOP owned companies. So your experience, Joe, matches the broader market. And then you can see too, there's been some other studies that basically, again, kind of echoing Joe's comments, that ESOP owned companies tend to be more productive and profitable. You can also see that they have fewer layoffs, lower turnover, and frankly, they're just probably more common than you'd imagine. There's a number of employee-owned companies out there, number of employees of employee-owned companies. So again, I think, Joe, it's a really great personal experience there, and neat to see that what you're experiencing corresponds with the broader market as well. So with that, I think maybe we should probably get into, okay, what exactly is an ESOP? And it's interesting, Joe coming from a banking standpoint and me coming from an employee benefits attorney background probably give a somewhat different answer, because I think when I look at it, it's an ERISA profit sharing plan. I mean, it's basically a profit sharing plan similar to a 401k plan with a profit sharing feature, except that the profit sharing contributions are vested primarily in stock of the company, just rather than purely cash that the employees invest. Just like how your profit sharing plan typically has a vesting schedule and an allocation formula, it works the same way with ESOPs. The difference is because the contributions are made in shares of employer stock, there's this repurchase obligation where after an employee terminates, the company buys back the shares from those individuals. But otherwise, operational control, management, a lot of the day-to-day functions remain the same. And I don't know, Joe, if you want to comment, I'm guessing from your standpoint, you maybe would answer this as a corporate finance vehicle or a stock purchase.
Yes, Greg, I think you're right. Yeah, I would view it as a stock purchase, and anytime you're doing any kind of acquisition of a company, the first kind of set of questions is to understand if it's a asset purchase or a stock purchase. So it's a stock purchase, and then I think as you're learning more about an ESOP, as you're sitting on the webinar where Greg and I intersect, where our firms work together, typically is one of two ways. It's not exclusive, but he may have a company where he's put together the ESOP, and then we're financing it, and so then we work together on behalf of the mutual client to make sure the banking goes well, and that we're following all the rules and regulations. And then the second piece, which is equally common, is if Greg did not put the ESOP together, I know what we normally have as a bank, we're going to have a lawyer read through our documentation to make sure it's correct. And why that's different than most of these stock deals, as Greg alluded to, there's a lot of ERISA information that I don't know, and it's changes all the time. So that's the only thing that I would throw out there, is there's a little bit of complexity, but someone like Greg kind of makes it simple, if you will.
Thanks, Joe. Yeah, and so why do we care about these different parts, the regulatory, the stock purchase, the corporate finance? And the reason is it provides a lot of tax benefits. And ESOPs may be the most tax advantaged vehicle in the Internal Revenue Code. And so we'll start with the business owners. What are the benefits of selling an ESOP if you're the business owner? And again, because of this unique structure, one of the big benefits is that you may have the ability to defer capital gain tax. So normally, if you as a business owner are selling the stock of your company, or selling the assets of your company for that matter, you're paying capital gain. And if you started the company, your basis probably wasn't all that much. And so for the most part, the purchase price that you get is going to be subject to capital gain tax treatment. With an ESOP, however, there's this Internal Revenue Code section 1042 that says if you're a C Corp and you sell to an ESOP, and again, there's rules to follow, but there's a very good chance that you'll be able to reinvest the proceeds from the ESOP into what's called qualified replacement property. Rule of thumb, it's basically stocks and bonds of any American corporation. There's some exceptions, but basically you can buy a mixture of stocks or bonds. You can work with a financial advisor such as Adam about how to set that up. But basically, you won't have to pay capital gain tax until you sell those stocks and bonds. And if you hold on to those stocks and bonds through the date of your death, you get a step up in basis, and then you don't have to pay capital gain tax at all. So that's a huge benefit to a selling shareholder. Now, again, you need to be a C Corp to do that. And there's times where if you're an S Corp, it might make sense to revoke the S election and do that. Sometimes it may not. So if you're an S Corp, you still get a little bit of a benefit in that you may be able to recognize capital gain treatment on the installment method. And what that means is typically with an ESOP, you get paid the purchase price, not all at once, but over time. And so you'd recognize capital gain as you get paid instead of all at once. So there's those great tax benefits to selling shareholders. From a business standpoint, some of the non-tax benefits are that ESOPs just tend to be a friendlier transaction than other M&A deals, especially selling to private equity. Because ESOPs tend to be financed by corporate borrowing and not by the trustee or the buyer paying out of his own pocket. There's much more of an incentive and greater probability that the transaction closes. You can also choose to sell all or part of your business to an ESOP. So every once in a while, there may be a business owner that says, hey, I'm not ready to sell everything at once. I still want majority ownership, but I want to take some chips off the table. So I'll sell a portion of my business to an ESOP, take my chips off the table, put some assets into something other than my business. And then maybe several years down the road, I'll do a second stage transaction and become 100% ESOP owned. It's also nice because you don't have any third party buyers or representatives coming in to examine the book. So it's a lot easier to keep the transaction confidential. And it's also just a great way to preserve the legacy of your business. I mean, ultimately, if you sell to someone else, it's their company now. It's no longer your company. But if it's an employee-owned company, you preserve the culture and everything else that you've established. I don't know, Joe, if you've got kind of any other comments on that or just observations, especially on the financing part.
Yeah, I think everything you said is true. And how we look at it, I like what you said earlier, is that we're kind of different. We're sitting at different seats at the table and everybody's trying to put an ESOP together. So we have a slightly different view. Whenever we're doing any kind of loan or we're financing something, we look at what's called execution risk. Sometimes it's called project risk. So if you're going to build a building, or maybe you're like adding to a building, there's literally the risk that the contractor is going to be more expensive, that they don't get it done, that the business is delayed. I think what Greg is saying, and a reason why banks really are starting to better understand ESOPs and like them, is the project or execution risk. I don't want to say it's not there. There is a slight risk, but it's significantly less than selling to a third party. So even when you're selling to a strategic, like if you own a paint company and you're selling to somebody, they may not be in that market, right? You just start to think of all the things that have to go right. And anybody that's ever sold a company or started working at a company, inevitably things go wrong. With an ESOP, it it's not a facsimile, but it closely mirrors the way the company was operating before the sale. So from a bank's vantage point, that's exciting, that's interesting, along with the other benefits that Greg mentioned.
Yeah. And just to try to put some numbers to this. So let's say that you're going to sell a business for $18 million. And the bank, they're not going to loan the whole amount, but they'll usually give you some, like maybe 2 times EBITDA is a good rule of thumb, sometimes more, sometimes less, depending on the assets. And let's say it's seller finance, and then they'll say seller financing makes up the rest of that, meaning that the bank provides 6 million of cash, and then as a seller, you take back the remaining 12 million in the form of a note from the company. And let's say it pays 10% interest over 10 years. Sometimes you'll see lower interest rates, and you'll be able to have warrants, which are kind of like stock options. But to try to keep the math fairly straightforward, we'll just use this example. And then, so what that means is, okay, at closing, that means you're going to get $6 million, about a third of the purchase price up front in cash. And then I used a mortgage interest calculator to do this, but it comes out to about $1.95 million of annual payments, including principal and interest, each year. And so what happens is you're not going to get paid everything up front with an ESOP sale, but you'll get paid over time. And with that interest, you end up getting over $25.5 million on an $18 million sale. Now, again, there's time value of money and all that. And then you add to the fact that you may be able to defer capital gains. If you've got time, an ESOP sale could be just as attractive or even more attractive than a sale to a third party. The other thing too is, if your concern is, well, I don't want to wait 10 years, maybe I plan on sticking around, I have a few years left in me, but I don't want to be waiting around 10 years. Oftentimes the banks will refinance every 2 or 3 years. And maybe Joe, you can talk about that. And maybe just in your experience, maybe despite these initial terms, how quickly or how frequently do you see selling shareholders get paid from an ESOP transaction?
Good question, Greg. So I think one, I'd answer directly how often the refinances happen and how easy they are and how those work. And then kind of the second piece is, if you're a seller, kind of how you get your money, and comparing it to some of the alternatives you mentioned, like selling to a third party and private equity, because it all kind of goes together. So a lot of times, if an ESOP is, it really is the sale of a company. And so the best time to sell a company typically is when you're about to have your best year. So it's what, 2024. So if like 2025 is going to be like your best year ever, you're going to have projections, there's going to be evaluation done, you're going to sell at a higher number, right? So that's very common. When we get a deal, we'll just make up a number. Somebody's EBITDA is 3 million, maybe the revenue's 30. In 2025, their EBITDA is going to be 6 million, right? And their revenue is going to be like 50 million. So they're doing better. So at the end of a year, they've had the ESOP for like 12 or 15 months, and they come back. That number that we look to lend on is now, again, it's 5 million in EBITDA instead of 3. So intuitively, the bank sees it as, we can lend more money. And then there's this excess cash flow recapture payment, which is a little bit complex, but the best way I would describe it is, the loans are typically small, where the monthly payment is small, so that there's, in case something happens bad or unpredicted, it doesn't hurt the company. And then they're able to make like a one-time payment at the end of the year. So 18 to 24 months is normally slow. What happens with the bank most of the time is something is sold when they're doing really, really well. So even people sitting in the credit department, which these are the people that are risk averse, they look at this deal and say, wow, we lent $7 million a year ago. They're doing so much better. We should lend more money. So a lot of times the bank is actually coming to the client saying, we want to lend more money. We really like this. So if you're the seller, that means, to Greg's point, you get your first bite of the apple. And normally in that second bite of the apple is kind of what we call it. You're going to get more money, not less. And then what I would share with others is, it sounds really great. It sounds unbelievable. If private equity gives you a check and you just walk away. What I think you'll see if you take more time and you look at even things like where public companies are bought and sold, it's pretty rare. It's not, it does happen, but it's pretty rare for someone just to cut a check. And so you got to just think about yourself. Would you buy a company and have like the leaders of that company and just like never see them again? So an ESOP, I think sometimes people think they need to work there longer. And then they get paid slower. In reality, as Greg pointed out, you can sometimes make more money, but I think the payback stream is quicker. And then what I would tell you as well is sometimes it's like 6 to 8 years. We have had a few situations, some were by choice, where a seller after 2 or 3 years said, you know what, I don't want to work here anymore. The company's frankly doing better. I want all my money. There's other kinds of financing that can be done along with the bank. It's like called like mezzanine financing, and we do that when we're doing a private equity deal or other kinds of structures. The other situation that happened that may be on the top of people's minds is we had a transaction. I can't share the company name, but the seller, after about 36 months, got very, very sick. And the family decided that it was meaningful for them to get the money quicker. And so again, we also used the mezzanine structure where we got in another party that replaced the seller debt. So I wanted to share that, Greg, because I thought you brought up a good point that it doesn't necessarily mean, I don't want to set the stage that you don't want to sell as an ESOP and throw the key away. You're going to need to be involved. But sometimes I think people think that they're going to need to be involved way longer than private equity, because I think they overestimate how long they need to be involved for an ESOP, and I think they underestimate how long they need to be involved for a third party. But what do you think, Greg? Would you agree?
I would agree. And to your point about private equity, I mean, I often see what they call rollover equity. So it's usually, seems like you sell to private equity and you may get paid something like 80%, but you've got to take back 20% of that purchase price in the form of equity of the buyer or some related LLC. And then you typically have to work there for another 3 or 4 or 5 years. And then when they sell that entity, then you may get that remaining 20%. So it's not quite as clean or easy as you may think. So I'll transition there. So the point of all that is, compared to other sales, financially, ESOPs can be, pretty attractive. And again, you get those tax benefits if you're able to defer the capital gain. And that kind of transitions us back to, okay, well, how does this benefit the company? And one of the neat things is, if the company's a C Corp, so let's say maybe the company was originally a C Corp and you sold and did the 1042, or maybe you were an S Corp and decided to revoke the S election, the debt that the company pays, often the interest is deductible, and often the principal will be deductible too. Maybe not all of it, but the reason for that is because the principal and interest, or the debt payments, are ultimately being used to kind of fund these profit sharing contributions that can lead to the greater tax deductions for the C Corp. normally only interest is deductible, not principal. So that's a great benefit to the company. But if the company is an S corp, this is where it gets really amazing, because if it's 100% ESOP owned S corp, the entity is a tax exempt entity at that point. The reason is an S corp doesn't pay corporate tax the way a C corp does. So there's no corporate tax, and the ESOP is a tax exempt shareholder. For corporate law purposes, there's only one shareholder, and that's the ESOP trust. It's not the individual employees. The employees are just considered beneficiaries of that trust. They pay taxes when they retire and get distributions out of their ESOP accounts. But as far as the corporation goes, there's no corporate tax. And again, if the ESOP is the 100% shareholder, it's not paying any personal income tax. And the result is that normally in an S corp, the corporation is making distributions to shareholders so that they can pay their taxes. Well, with an ESOP owned company, there's no distributions you have to make. Those distributions you would normally make to shareholders instead can be made reinvested in the business, or can be used to pay down transaction debt. So it becomes really profitable. There are some anti-abuse rules. It basically means you can't design the ESOP so that all of the stock is being concentrated in the accounts of one or two people. But it's a pretty tax advantaged vehicle, and Congress intends to keep that. I mean, both parties, there's bipartisan support for ESOP, so I don't see those tax benefits going away. You also get productivity gains and employee retention, because the employees now feel like they have skin in the game and that they're a part of something even bigger. And so just to kind of put numbers behind that, you look at net income, and again, it's a pretty simple example, but say you pay, roughly like 1/3 effective income tax, with between federal, state, and local income taxes. That's pretty significant cash flow. And if corporate taxes increase, or if personal income taxes increase, the benefit from the ESOP gets only better. And I think a lot of that goes to Joe's point earlier about why ESOP companies are so profitable. I would add, and maybe you can comment on this too, Joe, if a company is struggling financially, the tax benefits alone are not going to save it. So I wouldn't, kind of to Joe's point, if the ESOP is considered a last resort, it's probably not going to work. But if you have a stable company and you have a good culture, these tax benefits can make the ESOP owned company even better.
Yeah, I agree, Greg. And again, taking the strategy of figuring out who does what, you got with an ESOP, you're going to have a lot of advisors. As Greg mentioned earlier, I think your financial advisor is certainly going to be somebody helping the shareholders get ready for the ESOP and then manage the funds post ESOP. But as the bank, I do understand what would be conceptually a good ESOP, what some of the benefits are, but I don't actually work hand in hand with, let's call it the IRS, to make that determination. Normally when somebody are coming to me, they've already worked with Greg, they've worked sometimes with an investment bank, and from time to time, we'll get asked to refinance an ESOP. In other words, somebody did an ESOP, they did it with another bank, and they want us to get involved and be their bank. And most of the time, that's a great phone call. But occasionally you do get ones that Greg alluded to where they thought, or somebody told them that, hey, it's like a magic wand. If you become an ESOP, even if you're just like struggling, you're going to do great. Well, if you weren't profitable before, then right, if you're not making money, then who cares if you don't pay taxes, because you didn't pay them before, you weren't making any money. And in fact, I would argue, if you're a smaller company, under $1 million in EBITDA, or kind of 10 million in revenue, and you're struggling, an ESOP compounds the issues because you have certain expenses that you need to handle. As I look at ESOPs, I would say, like, maybe 2% fall into that category that I've dealt with, just as like anecdotally. So there may be more out there. I don't know, but it's pretty rare. The benefit, I think, we remain neutral as the bank, so we don't recommend that people make a 1042 election or kind of become tax free. But in general, we look at that money that was going to go to taxes. So I think you used a third. Well, a third of that is available for debt service. Once you pay the debt to the bank, maybe there's other debt as a life cycle of a company, equipment, and so on. There starts to be money that stacks up, right, in the cash, in the deposit accounts for the company. So it becomes a lot more stable. So that's probably why over the last 10 or 15 years, banks have become a lot more comfortable. And we've also seen, ESOPs have a certain life cycle where you start having the repurchase obligations happen. And so we're able to have data that shows how do people perform when they get the loan initially, how do they perform after everything's paid off. And the data that we're seeing that, it might be part of Greg's presentation or he could comment on, is that these companies tend to do better than if you compare them to just the general companies that are privately held. So Greg, I don't know, I guess that's kind of a question back to you, but if that holds true, but for our experience, the data we've seen and clients at our bank, they actually, just as a general number, tend to do better.
Yep. Yeah, and I would agree. I mean, I think in the 80s and 90s, the ESOP was kind of used as the last resort, but I think especially the last 10 years and probably more like the last 20 years, I think the ESOP community's really kind of cleaned up to make sure these transactions are successful. And so with that, we'll kind of get to the last piece. We talked about there's some capital gain savings and maybe even other financial benefits to the selling business owners. You see the tax benefits to the company. The last piece is, how do the employees benefit? Well, one, again, except from some of the numbers we showed earlier, ESOP owned companies, because they're performing better, tend to have fewer layoffs, less turnover, so the jobs are protected. The legacy as an independent company is protected. And a lot of what we see too is that the employees actually appreciate being, especially younger employees, appreciate being part of an employee-owned company. I've heard anecdotally, for example, that Honda, for example, they may be able to attract some great engineers because it's Honda. It's a huge multinational corporation. But some of the smaller, maybe part suppliers, they end up being able to attract some of the engineers that Honda would otherwise hire because they're ESOP owned. And those prospective employees say, well, hey, I like the fact that I'm part of something and that I'm not just a cog in a machine, but like I'm actually an employee owner. So it provides some good management or good incentives to the key employees. It also provides a great supplement to their retirement benefits. So ESOP-owned companies typically will keep their 401k plan, so the employees still get to defer their own money. You may not make a profit sharing contribution anymore because you have the ESOP. A lot of times they'll still keep the match. So between the 401k plan and then the ESOP, that's often, I mean, frankly, it leads to a lot of millionaires for people who probably never otherwise would have become millionaires. So it's a great benefit there. And then the other nice thing is that there's also opportunities to provide special like management incentive plans or kind of phantom equity to key management as well. So it's a great way to reward, motivate, attract, and retain key employees. So kind of pause there, like we kind of went through the benefits to the different stakeholders and why we're seeing a lot more ESOPs lately than maybe we have in the past. We'll transition now, and we won't spend too much time, but just give an overview of the process and how how an ESOP transaction works. And Joe talked about this to some extent too, but it's not a decision that you make overnight, but basically you kind of start with education. So you start with this presentation, maybe you go to another one, or maybe you follow up with one of us to learn a little bit more about ESOPs and how do you know if they're right for your company or not. And if it sounds interesting, then you usually get what you call a feasibility study, where somebody does the financial modeling and says, okay, can the company support the debt? What purchase price do we think we could get? Does this make sense? And then if the answer to that is yes, then it's like, okay, let's hire the team and get going with the transaction, and we'll do due diligence and get the documents negotiated and all that. If the answer is no, then it's often, okay, well, what do I need to do to get there? I don't know, Joe. I mean, I know you're not doing the valuations or like the actual ESOP feasibility, but I know the bank, there is a role for the bank to play. Maybe you can speak to that.
Yeah. So we clearly have a current book of customers, right? We are always looking to help customers beyond being the proverbial ATM. In other words, you want to provide value outside of, hey, I literally just need money to go buy this equipment. And so one of those would be, using the phrase exit planning, or helping people increase shareholder value. And so some of that conversation is, looking at a client and saying, hey, you might be a good candidate for this. And so that's certainly something that happens with our current customers. And then with prospects, it can too. And then the bank is normally one of the stakeholders that's the recipient of a lot of this information. So you mentioned like evaluation. We don't see the first valuation, but then every year thereafter we see it. We don't pick the trustee, but we interact often with the trustee. Borrowers have their own legal counsel, but that's how I got to know Greg. I'm going to interact with him on questions of things that, we may want to do, and he needs to make sure that it's good for his customer and that you can do that, because it's an ESOP, it follows ERISA guidelines. So we really we're interacting with the accountants. There's certain things that we want to see that we need the accountant to start to do. As an example, sometimes companies have really basic non-GAAP company prepared information, and they just do tax returns. And so on an annual basis, they need to up the game and get reviewed or audits. And then normally their company prepared then would need to be maybe not GAAP, but pretty close. So in layman's terms, that means, you want to start to have accruals. So if you have receivables and payables, have those be part of it. So that's kind of the role that bank plays. Is I feel like we need a lot of the same stuff, and then we're really the recipient of a lot of the information. And then I feel like sometimes banking is a black box for a lot of people. When we do an ESOP deal, we're regulated, right? So the FDIC comes in and they look at our loans. What they would look for is, did we use outside counsel? Are we following the ERISA guidelines? Are we collecting the valuation? Do we have an ESOP strategy or lending strategy? Are we adhering to that? So that's some of the stuff that comes up with a bank. And if we were like willy-nilly recommending that people do an ESOP without talking to good legal counsel or without talking to an investment bank or things like that, that would hurt us. But then the way that we're regulated, other people would see that too. So hopefully that's helpful, Greg.
Absolutely. Yeah. I mean, the key is you want partners that have experience with ESOP. So you want somebody who does evaluation, who's doing the valuation estimate and the feasibility study to understand how trustees value the business. And you want bankers who understand that, yes, it's a leveraged company, but seller debt's a lot of ways kind of more comparable to equity than actual debt, things like that. And then just have a team that knows how to negotiate ESOP deals, knows how to prepare, the different stock purchase agreements, loan documents, and employee benefit plans with ESOPs. So that's a little bit of an overview of how the process works. We'll talk about governance next, because sometimes what we'll see is when you mention ESOPs, they'll say, well, I don't want the inmates running the asylum or the employees running the show now. It doesn't work like that. So as I mentioned earlier, you have an ESOP trustee, and that person is appointed by the board of directors. The trustee is the fiduciary who represents the participants in the ESOP, has the voting rights, is appointed by the board. So there's kind of this checks and balances. And maybe to simplify it, when you sell to an ESOP, what's going to happen is the trustee is going to want to see that there's a board and that there are some corporate formalities being practiced. The trustee has no interest in micromanaging your company. Most of these trustees have dozens of other ESOP-owned companies that they're a trustee for. They don't have the time to micromanage the business. It's not a whole lot different than if you were to buy stock in, say, Apple or Walmart or any publicly traded company. You're not there to take over the business. You're there because you think you're a shareholder, because you think they're well-run companies and you want to get the financial return. And that's really what the trustee's doing. The trustee just really wants to collect the trustee fee each year. And the trustee just is a general believer in employee ownership. And they just feel that investing in these employee-owned companies is just a good thing to do. So what they'll want is they'll say, okay, maybe before you were the ones as the owner making the decisions. Now we want to see a board. And maybe at first we'll have a 3-person board, and you as the seller can be on the board. And if there's a trusted management employee, some cases, maybe even your spouse, they can be the two of you can be on the board, but the trustee is going to want some outside independent person who isn't subordinate to you in some way or isn't a service provider to you. And that just ensures the trustee, like, hey, there's somebody there to provide advice and make sure that they're examining like the different financial issues, human resources issues, strategic issues. So you have this 3-person board. Trustees just going to want to see that they have, usually like 3 meetings, maybe 4 meetings throughout the year, and that there's minutes actually taken. So again, if there's a meeting to discuss the budget and the finances, maybe the CFO gives a presentation about that, and there's a summary in the minutes. If it's HR related, again, somebody's giving a presentation to the board about that. It's really just to make sure that the company is well run. Again, if there were ever an issue, the trustee, in theory, could vote to kick out a director. But again, they really have no interest in doing that. And usually what will happen is if the directors say, hey, this is what we recommend you vote on, as long as there's documentation to support it, the trustee is going to approve it. And then similarly, the board, if they ever got frustrated with the trustee, could always replace the trustee too. So again, it's somewhat of a circular governance system. But the point is, really, the main point is that from a day-to-day level, not a whole lot's going to change. You may have a few more formalities to follow, but nothing too different. And then from there, who makes a good ESOP candidate? You can see some of the factors here. I don't know, Joe, if there's anything that stands out here, or if there's anything in particular you want to mention about who a good candidate is.
Well, the biggest thing is because we're financing, even if you're doing seller debt, you're financing something is the debt capacity, and really that's stable or linear cash flows.
Yeah.
And normally, if you have stable cash flow, 99 companies out of 100 that have stable cash flow, they're going to have a lot of these other things, right? Like a strong management team, a solid operating model. And when we say stable, we're looking at like over a 3-year period at a minimum, but normally a 5-year period. And if things are increasing, that's okay. That's typically a good thing. But I would say if like things are increasing over 20 or 30%, I know that is positive typically, but that actually can be seen as unstable. And so depending on the reason behind the rapid sales growth, they may not be a good candidate. And we can get into other reasons, but that's probably the biggest one where people come in and want to be an ESOP, and like they made like 3 million one year, they lost $1 million the year before, and then they made 5 million 2 years ago. That's a perfect scenario of not a good candidate. Those would be my thoughts, Greg.
Yep. No, excellent points. And so with that, I know we're coming up to the end of our time. So it's like, kind of what's the next step? And look, to be honest, I know a lot of this may be overwhelming. I know when I first started practicing with ESOPs, it took me a few of these kinds of presentations to grasp everything. But really, the more you hear about it, the more you're going to retain, the more you're going to remember. And if it sounds interesting, ultimately the next step is a feasibility study. And so you're asking someone, a financial professional in this space, to say, okay, like how would an ESOP work with my company? What value could I get for the business? Can the company support the debt? What does the transaction look like with, in my example, for example, 10% interest? Is that the right way to go? Or would it be better, maybe I take 5% cash interest and maybe I get warrants? What would it look like if I'm an S corp to revoke the S election to do 1042 versus 1042 and defer capital gain versus taking the installment sale? So it's really just, again, getting more information, seeing if an ESOP can work, and then deciding, okay, do I want to take that next step? So that kind of wraps up, I think, the points we wanted to talk about. I don't know, Adam, if we have any questions or anything else you want to add? You're on mute, Adam.
Thank you. I was just talking away. Because we're looking at 12:59, I want to respect everybody's time. And we do have 2 questions, but what we'll do is offline, Joseph, Greg, we'll discuss those questions. We'll get the answers, and then what we'll do is Gina here at our office will shoot the answers to all the participants to those questions so that we get them answered. And then what I might do also is we might answer those questions on the podcast as well, which we're going to record here in a moment, and that'll probably be published. I believe it's August 1st is we're publishing the podcast on the same topic of ESOPs. So with that being said, thank you all attendees for attending today. And if you'd like to get a hold of either Joseph or Greg, you can see their emails are right here on your screen. You can also get a hold of them on LinkedIn as well. But our next event is going to be surrounding the topic of everything you need to know about recruiting and retaining staff. So it's not easy these days, especially post the Great Resignation, if you will, to get good people, and it's not cheap anymore either. Not that it was cheap before. So be sure to tune in that. Again, I'm taking August off. We're going to be doing our next event in September. But please head over to elevateandexit.com to sign up for the invitations to those future events. Again, subscribe on YouTube to get these replays sent to your inbox in the future as soon as they're published. We'd really, truly appreciate it if you'd fill out the survey that you'll be hitting your inbox from Gina. As we'd love to hear what you think, as well as, if you have any ideas, concepts for future events, please, let us know what ideas you have, and we'd love to take one of your ideas and make it a reality via a webinar, podcast, article, or all 3. Please follow Elevate on LinkedIn, Facebook, Instagram, and Twitter. And lastly, as I always say, owning a business is freedom, it's fulfilling, and it's unbelievably rewarding, but it's not easy. So, why do it alone? Elevate doesn't exist without all of us, without you. So thank you once again for attending, and we look forward to seeing you at our next event.